Ladies and gentlemen, welcome back. This is Christopher Aaron. It is April 16th, 2020. And when we look at gold and silver in this broadcast, here's what I'm going to show. This is going to be a special broadcast where you're going to get to see a portion of the members-only update that went out just 3 days ago. And it's a segment from that update in which we are going to look at the following topics. What actually happened back in 2011 that caused gold to top and then fall almost 45% from above 1,900 per ounce down to a little bit above 1,000 per ounce. We're going to look at that in some detail. There is a policy that the Federal Reserve announced in 2011 that actually served as the trigger for gold's top. And we have to look at that, especially with respect to what is setting up now in the precious metals. In the second part of this video, you're going to see the strategy that we are outlining here to find relative value in this sector. So, for example, if gold is already above 1,700 per ounce, yes, one can buy gold at this point, and I think everyone should own some gold, depending on your risk tolerance and your time horizon. It is good to accumulate gold for the long run. However, there are some portions of this sector that are valued at such a discount to physical gold that the relative value actually lies in those portions of the market. So you're going to see the strategy that we will be pursuing here, and then you can decide whether or not that's something you would like to follow along with and follow with our strategy, or whether or not this makes sense for your own strategy. So on that note, I wanted to announce what I announced last week, the limited time offer, a 2-week trial of our premium subscription is now available for only $1. You must use the link below in order to sign up. Use the link below, sign up. This gives you 2 weeks for only $1. There are no gimmicks, no catches, anything like that. It's $1 only. That gives you the chance to view all of our member videos, the full video that you're about to see now, of which you're going to see a segment of, as well as look back at all of our research and all of our archives coming up. If you would like to keep the subscription going, you don't have to do anything else. It will renew automatically at the normal annual rate. If you want to cancel, all you have to do is hit the cancel button within your PayPal profile or email the customer support team within the 2 weeks. After the 2 weeks are over, we don't offer any refunds or cancellations after that point. So you have a full 2 weeks to try everything for $1. Now, pay attention to the video that is coming up, because this strategy, I think, is going to outline where value exists in this sector. If you think you've already missed the move, for example, in gold or in silver, I want you to watch this video very carefully, because you're going to see where the relative value still exists. Big picture. Why are we cautious on gold at this time? So what I want to do is bring up the very long-term chart and just let's all take a giant step back. Let's look at the major data points here. The 20-year low back to 1999, right? The 11-year rise up to the all-time high in 2011. Crash of 2008. Notice how the crash of 2008 bounced right here at the same trend line that was hit in 2005, 2006, which previously was resistance going all the way back to 2001. And then follow my mouse here. Notice the same trend line served as support in 2015 and in 2018. So this is our major upper support level, and our major lower support level, let's not forget about it, is all the way back here. Right now, it would still be below 1,000. We've got an embedded, more steep rising trend right now that has begun from the 2018 low. This is still rising fairly aggressively. Of course, at this point, this last rise here that we've seen, especially just over the last couple weeks, it's getting very close to vertical. Can you notice the trajectory here where my mouse is compared to the little last ascent here? Let's say from 1525 up to 1925, right? The last $400, remember how that went almost vertical back in 2011. So we're getting close to an ascent similar to that back in 2011. And so a thinking person from a risk to reward standpoint really has to ask themselves some tough questions right now. And so what I want to do is focus on that last rise from the 1400 level to 1900. Let's use round figures. That's a $500, let's say the last $500 move of that bull market from 2001 to 2011, and the current, let's say, $400 move, because we're plus or minus $100 away here from some of those peak levels, 150 or so. So I want to compare these final two ascent periods in the gold market and see if we can notice some similarities. Let us compare. Remember, we're looking at the last $500 of the move here. Here was that $500 on gold from 1400 in late 2010 up to 1923, 1,923 in 2011. Notice how gold rose $500, and what happened to the gold mining companies? They moved completely zero net gain. They discounted this entire $500 advance. And I heard every excuse under the sun every couple of months as this was happening. I heard people say, well, they underperformed for so long, so people just don't care about the gold miners anymore. Or I heard that they can't raise funding because, it's still a remnant from the crash of 2008. Or I heard, well, their input costs have risen too high because oil and electricity prices have risen faster than gold prices. I heard every excuse under the sun to discount sideways gold miners, rising gold price. I'll tell you what happened in just a moment. Let's look at the current period. What do we have again? Sideways to lower gold miners amidst a $400 rise in gold. Almost exactly the same scenario here happening as gold approaches that 1900 level that happened back in 2010, 2011. I mean, just look at the similarities here. You couldn't make this stuff up. So the significance of this, remember all those excuses that could have been given. I was taking extensive notes during this time. I was investing during this time. All those reasons given. What was the actual reason? There is what we were just looking at. The gold miners moving sideways. Gold rising $500. This was a warning signal for an 80% collapse in the gold miners and a 45% bear market in gold lasting the next 4.5 years. So I reiterate one more time. We are seeing the exact same set of signals right now as gold takes on that same quasi-parabolic ascent to the same $1,900 level. And if you're telling me that you just want to ignore this, that's fine. You can do that. You can, to each their own. There's nothing wrong with that. Everyone has to make their own decisions according to their own risk and reward tolerance. I understand that. However, where I sit here, I am going to note these data points and I am going to incorporate this into my game plan, which is telling me to not chase this ascent here in the gold market. And it's telling me that furthermore, we may be looking at something of a similar top. Perhaps not as much of a sell-off, maybe only several $100s, maybe back to the long-term rising trend line around 1,400. But something like this, something is wrong with gold's ascent if the gold miners continue to discount everything. So I want to talk about a fundamental data point here as to what would explain this type of expectation here. Let's go back into history. What caused the peak in gold going back to 2011. Does anyone remember what caused that? As far as a fundamental trigger, if we can look for one trigger, obviously there's a million data points coming into the market at any one time. I always say that as well. But sometimes there's a trigger. The coronavirus was a trigger recently for this round of deflation that we've had. What was the trigger for the all-time high here in gold? I will tell you. So just to rewind, we had QE1 and QE2, quantitative easing, starting from the crash of 2008, where the Federal Reserve said, we're throwing off the previous pretense that we don't print a lot of money, and we're just going to start printing money. And with that money, we're going to buy bonds. So the first round of QE was somewhere like 750 billion, and then there was another 600 or 700 billion in QE2, and that gave us the rise in gold here all the way to the top. Now, what happened at the top? What changed? Operation Twist. Operation Twist was announced on September 21st, 2011. What was Operation Twist? Let's look at this for a moment, because this, I think, gives us a good example of why we should be cautious for something coming up here in the near future. September 21st, 2011, the Fed announced that it has a plan to purchase 400 billion more of bonds, of course, with freshly created money. So this is QE, this is money printing, with maturities of 6 to 13 years. Yet, to sell bonds with maturities of less than 3 years, thereby extending the average maturity of the portfolio. So as opposed to just outright buying with freshly created money, they were going to sell an equal amount of bonds under 3 years of maturity to purchase these bonds at 6 to 30 years. In other words, they were not going to print any more money. It was going to be a swap. That's why they call it a twist, Operation Twist. So as it goes here further in the article, this was an attempt to do what QE tries to do without printing more money and without extending the Fed's balance sheet, thereby hopefully avoiding the inflationary pressure associated with QE. This coincided within a few days of the all-time peak in gold here, Operation Twist. And so think about it from a logical standpoint. We had the entire market for 3 years pricing in further money printing, further money debasement, monetary debasement, more stimulus, right? The gold market thought that was just going to keep happening forever, and gold was going to keep rising. When a market prices in money printing forever into the future, but suddenly the Fed comes out and says, actually, we're going to stop, this is why a top forms, because you have a market that has basically had the rug pulled out from underneath it. Because a significant amount of the late buyers here in gold who were expecting QE to continue forever then said, oh, wait a minute, it's not continuing, get me out of here. Operation Twist is what triggered the all-time top in gold back in 2011. Fast forwarding, we had QE 3, 4, 5 causing the base here. And what did we have just recently? QE to infinity. This was just announced on March 23rd. So they've thrown off the pretense of it being a compartmentalized certain amount, and they're just saying we're going to print more until we say otherwise. So think about this again. We once again have the gold market approaching this near parabolic trajectory here, very similar to 2011. We once again have the pretense of continuous money printing. What else do we have? We once again have the gold miners not believing it. This leads to a very strong probability that what is going to happen and why the gold miners are not believing the present move in gold is that we have something that is going to be like an Operation Twist Part 2 that is going to enter this market at some point within the next year. And this is going to be a major surprise for everyone. Think about it once again. The market is pricing in. Everyone who's buying gold right now is thinking QE to infinity. And so it is buy, buy, buy. They're not going to stop printing money. What happens when all of a sudden they say, actually, we're going to pause or stop for a while? That is what's going to cause the next top into gold. I suspect we are close to it. It could be a little bit later in this year after one more peak, and we will look at some of the strategy questions now for gold. That is the highest probability. When I remember, as someone who supports gold, I actually think gold should be remonetized. If you want to ask me fundamentally, I think gold should be the basis of our currency. I think it's an abomination that we have fiat currency. That's my true belief in my heart. But I cannot ignore what the market is actually showing me. And the market is giving me these major warning signals. So that's where I am fundamentally and technically. Now, there have been some member questions that I want to address. So some subscribers have asked, what if gold breaks out here? So what if gold doesn't top, let's say at 1800 or 1900? And let's be honest, that could happen within the next week. The way gold is moving, $100 higher or lower every week, we could see another test at 1900 within the next week or two. What if gold doesn't stop? What if it doesn't stop? What if it, gets up to 1900 and just blasts through? And next thing you know, we're looking at $2,000 gold. What if this is the first time in all of recorded history, and we have looked at every period here in this service? Please, if you're new to this service, go back to the member archives and look at all the previous times. We've shown that every single time that the miners have underperformed in this way, it has not led to a sustainable move in gold. But let's say, for example, maybe this is the first time that happens. Maybe this is just a completely new paradigm that we're in. What then from a strategy standpoint for the next year, if we want to try to profit on the break, let's say above the previous all-time high? Here is the strategy as it is going to be outlined in this service. This is what we are going to do. And this may be something that you should consider. So let's bring the gold chart back up. So we're talking about this. If we just blast off here, what do we do? First of all, if we blast off and break through the all-time high and we're approaching 2,000 or above 2,000 gold, there will be, at some point in a vertical move like this, there will be a first major sell-off. There will be. You can study every market that is going to, let's say, make a huge cut pattern like this and then eventually reach prices. Let's say if this is the time that the Peter Schiffs and the Mike Maloney's are right and we're going to 3,000 and 5,000 and 10,000 gold, there is going to be a first sell-off after we break the all-time high. That first sell-off from a technical standpoint is called a retest. It could come anywhere at 1900 all the way down to 1800. If you follow back all the way here to the left, you'll notice 1800, just above 1800, is really the more significant resistance, right? 1, 2, 3. 1900 was like a real fleeting type of move. So the retest could come anywhere from 1900 all the way back down to 1800. The strategy will be to look for value in the gold mining complex, assuming one already has their core physical gold position. If you don't, the retest would be your time to average your way into that. But assuming you already have that, the retest will be the time to move down the food chain toward the more undervalued components of this sector, because then this really is going to be it. If we break this all-time high and have a successful retest, then even I will admit this is the time when the gold miners have just been wrong. It'll be the first time in history, and I will welcome that because there's going to be a tremendous continuation move beyond that point. And so the strategy is going to be on that successful retest of the all-time highs, we will be moving down the food chain in this entire sector. We will be looking for value. And trust me, there's tremendous value still in this sector. You will see what I mean in a moment. What are some examples of that? Well, let's take the obvious one. First of all, if gold is approaching the all-time highs here, what do we think is the next move for silver? It's very logical. Silver is going to be the next thing to go to its all-time high. And the way it's moving now, that still is greater than a 200% move from present prices, right? So there's a delay here. I think we will have time to still capture some of this move if that is going to be the case. If the analysis that was presented earlier on in this video turns out to be wrong, we will be moving down the food chain towards silver. What else will we move down the food chain toward is the senior gold miners, which are still needing to move 150% higher just to get back to their related 2011 peak from where they are right now. This is not going to happen overnight, even if gold breaks its all-time high. What else will we move down the food chain toward is the junior gold miners, which are 300% below their 2011 peak. I mean, the divergence, can you see what I mean here? There is tremendous value. If this is going to be the bull market and these gold miners are wrong, we have not missed nearly anything of this move, really. And there are companies that are actually closer to their 2015 bottoms right now versus this GOEX fund, which is a junior miners fund, which is somewhere in the middle of that range from 2016. Another way that we can look at this, the massive underperformance, is by consulting the junior silver miners to gold ratio. So think about this. We're talking about here, I bring this chart up once every few months. We are talking about the speculative appetite, the most speculative end of the sector versus the least speculative end. Physical gold is the most conservative, and the very small silver miners the most speculative. And so we can measure psychology of the precious metals market from this chart. And we are nowhere near the level that we were in 2016. For this chart, for the junior silver miners to be valued where they were, according to the 2016 peak, they would need to rise 200% from where we are right now just at today's gold prices, let alone $2,000 or $3,000 gold. So plenty of opportunity coming up here to move down the food chain if the analysis, the bias that gold should be setting up for a top, if that proves to be wrong, I think we have plenty of opportunity over the next 12 to 24 months. And that's when we'll be getting back into looking at individual companies. We will take a look once again at companies like Spanish Mountain Gold, Impact Silver. We will look at some of the companies that have really struggled, that have very high cash costs, for example, because if you start getting $2,000 gold, even the companies that are barely profitable, let's say at $1,500 gold, suddenly they're going to be profitable. And you do not just move on a one-to-one basis. When a company goes from being unprofitable to profitable, it can be revalued by a 5 to 10x fold. So significant leverage possibilities are still available here in this sector. Okay, so that was the segment from the members-only video that just went out 3 days ago. Like I said, you can get all of that video for that simple $1 trial. Just use the link below, and we hope to have you convert to full membership after that. You get a free consultation with your full membership with myself, Christopher Aaron. You can use that at any point in the next year. A 30-minute consultation. We speak one-on-one about your situation. I do not sell the precious metals, so I'm not going to always tell you to buy. I do approach this from an independent standpoint. If you would like to speak to me sooner and you just want to book a 1 hour or 30-minute slot, please know that I am available by consultation. You can find more about that on the Consultations tab. I do want to make sure you hit the subscribe button either way, and I want to thank those people who are supporting this channel on Patreon. So like you could see from this video, I think there is a ton of opportunity in this market. over the next year. We just have to be very careful that the market doesn't try to surprise us here as it's clawing its way back toward 1900. We still do see that negative divergence setting up between gold and the gold miners. That has never been the signal of a sustained bull market ever in the past. If it is going to work out differently this time, there is value to be found. You can see that value. Silver is undervalued. The gold miners are undervalued. The junior gold miners are extremely undervalued. Pay attention to those segments of the market as we go forward here. Thank you. Stay healthy. Take care of yourself and your loved ones, and I will see you this time next week.